and welcome back. Today we will be doing this particular question called Toltuck company. Okay, so in this case, what is it? Toltuck is a listed company in building industry. Okay, listed company which specializes in construction of large commercial and residential developments. Toltuck has been profitable for many years but has also incurred major losses on the last two developments which it has completed in its home country of Arum land. These developments were out of town, retail center, and a major residential development. Toltalk directors have blamed the poor results primarily on the recent recession. Right? In Arumba land, although demand for the residential development also appears to be adversely affected by it being located in an area which has suffered serious flooding over the last 2 years. I forgot to read the requirements, but let's go for it. Calculate the valuation and yield to maturity. Valuation and yield to maturity of Toltalk's $100 bond under new and old and new credit rating. Okay. After the credit rating, the valuation will change, right? So that is 10 marks. Discuss the factors which may have affected the credit rating of Toltalk company, right? So we which factors have affected, right, the credit rating. Discuss the impact of the fall on credit rating on its ability to raise financial capital and on its shareholders return ability, right? You see, they have a recession going on, and then what has happened, it's suffered a major losses in last two developments, right? So because it was out of town and a major residential development, right? So these developments were out of town and major residential development. So have blamed the results on recent recession, although the demand for the residential development also appears to have been adversely affected by it being located in an area which has suffered serious flooding. Okay, so this is the background information. Right, as a result of this, returns from two major developments being lower than expected, Tolton company has had to finance current work in progress by a significantly greater amount of debt finance because they lost some because there was no demand, so there is some kind of liquidity situation, right, in the company, and then they had to do it basically get the money by debt, right? So giving it a higher gearing, right, than other construction companies operating in Arumba land. Okay, Toltalk directors have recently been alarmed by the major credit agencies decision to downgrade credit rating from AA to triple B, double A to triple B, right? The directors were very concerned about the impact this will have on the valuation of Toltalk bonds and the future cost of debt, right? Of course it will increase. Let's see. The following information can be used to assess the consequences of the changes in Toltalk company's credit rating. So we have to calculate the value of debt before and after, right? After the change in credit rating. Toltalk has issued 8% bond which has a face value or nominal value of 100 and a premium of 2% on the redemption in 3 years time. The coupon on the bond is payable on an annual basis. Okay, so that's the bond information, right? The government of Arumba land has 3 bonds in issue. They have all face value nominal value of 100 and are all redeemable at par. Taxation can be ignored on government annual bonds. They are of the same risk class, and the coupon on each is payable on an annual basis. Details of the bonds are as follows, right? So 1 year bond is currently trading at this much price, right? Current market value is that much. 2-year bond value is that much. 3-year bond value is that much. So credit spreads is given, right? So we will need to add it up later on. Okay, published by the credit agency are as follows, right? So first of all we need to calculate the value as well, right? We need to discount it back as well. Then after that we need to calculate yield to maturity as well. All right, and then after that we need to add these things to the credit rating, right? This is the basis points, right? In basis points, so we'll need to add it up. And then shareholders base can be divided broadly into two groups. Okay, so they have given us this information because in the third thing there was something about shareholders as well, right? So shareholders are comfortable with investing in a company where dividends in some years may be high and where there is low and no dividends in other years because of the cash demands facing the business. However, a minority of the shareholders, what about the minority, right, would like to achieve at least a minimum dividend each year, right? So they might be concerned and are concerned about the company undertaking investments which they regard as very speculative. Shareholders are both have both expressed concerns to the board about the impact of the fall in credit rating on their investments. Okay, that's pretty much it. Let's go and calculate the valuation and yield to maturity, right? Both of them. Let's do it. So what does the answering tips has to say about this, right? I think I can just move it to the side somewhere and then I can do it this way. Right, this is a 25 marks question from June 27 exam paper covering bond valuations, bond yields and credit rating, right? Bond yields and credit rating. So the question was based on topics covered in examiner's article from 2011. Interesting, there was a question on September 2016 exam paper that also tested the contents of 2011 technical articles. Students understand how important it is to read examiner's recent articles before they attempt the exam, but this demonstrates how important it is to read all the previous technical articles. If students were familiar with the contents of 2011 technical articles, the question would have been very straightforward. Okay. First of all, we need to estimate the government yield curve, right? Basically, because these yield curve, based on that, we will need, you see, like we've been given the credit spread, right? Spreads is there. So we will need to basically add the spread to the government yield curve, right? So first of all, in order to estimate the yield curve, what we need to do is we need to discount it back. The valuation is what? 104, right? What is the current value right now, right? So 104. So let's just say present value equals to future value divide by 1 plus R1. Okay, so you could just say like you should remember the formula, present value 1 plus R1 will give you the future value, right? So we are just changing that formula up a bit and then just giving you an example. This is not exactly similar, but yeah. So basically our present value is 104, the future value is 109. In 1 year's time we are going to get that much. How? Because it is being redeemed at how much? 9 is your interest and 100 is your face value, right? So there is no premium on it. So 109 you'll be getting in a 1 year period. So what's your return then? You could calculate it, right? So 109 divide by 104 and then you have minus 1 over here, R, right? So you could get R of return of how much? 4.81, right? So the government yield curve for bond 1 is basically 4.81, right? And then for bond 2 we do something similar, but there is some caveat over there. Okay, there is some caveat over there. What you need to do is present value equals to future value 1 plus divide by 1 plus R1 plus future value divide by 1 plus R2 to the power square. So 102 equals to 7 divided by 1 plus R we found out. You see, in the first year it is 4.81, so 0.481 plus the redemption we are getting is 102. No, it's 7%, so 107 we are getting in the second year, right? The amount that we will be receiving back. 1 plus R is basically what? In this case we don't know, it's a square, right? So we basically solve it. How do we solve it? We solve it basically, what you can do is 102 minus 6.68, you solve this thing first, equals to 107. Okay, and then what do you do? 1 plus r square, right? And then let's say you've got then after that 1 plus r, you bring this thing over there, and then you divide 107 by 102 minus 6.68, right? And then you just do 1 by 2, right? And then r equals to 107 1.2 minus 6.68, 1 by 2 minus 1. Okay, that's how they have done as well. See, and then similarly, why do you need to be careful over here is basically you have to use the rates that you found out in year 1, huh? So it's important to not to make any mistakes in the year 1, otherwise all your values will be mistaken. Okay, so it's very important that that's not missed out. So what's the value in the first thing is basically you will be getting how much money you will be getting, right? And then what's the present value? Based on that we calculate the rate on it, r on it, r1 on it, right? And then in the second bond, what will happen? For the first year you are getting this much yield, right? For the first year, and then in the second year you don't know, you calculate r2. And then for bond 3, it's for 3 years, right? So in the first year it's getting this much, we discount it using that rate. In the second year you're getting this much, you discount it using that rate, you square it as well, right? It's for year 2. And then in the third year you don't know, so you calculate all this thing. And then what do we do? That's now we can calculate the rating, right? So what's the rating for, or what's the borrowing rate for Toltuck company, right? Right. And then for that we put in the government yield curve, right? Within that we add the spread, right? 4.81 plus this amount 0.18, right? 18 basis points, and then we get 4.99, right? For 1 year. For the second year we get this much, for the third year we get this much, right? And then after that what do? We add in the new spread. The new spread is basically, where is that? Old rating, right? Is there a change somewhere? Okay, because you see this is for AA, right? This is for triple B. Okay, because we were previously, this was our credit spread for basically this in basis points, it was this much, right? But for since our credit rating has changed to BBB, we will need to use the another spread. Okay, new rating spread. So on that, now what we do? We add government yield curve plus this amount, plus this 0.54. Okay, not on this thing, not on the old rating itself, but on government yield curve plus the spread. Okay, it could be easily missed, right? In exam situation, time pressure, right? So yeah, basically on that thing, now we get all this new credit rating, right? Now we can do the valuation. Okay, now we can do the valuation. So under the valuation, what we need to do, in the first year we have a what's our bond? It's 8%, and then 88, and then 2% redemption in 3 years time, right? So 2% redemption, 2% premium, I mean. So it's going to be, you're going to pay out 8 in the first year, second year 8. Why is it 110? Because it's 8 plus you'll have to pay the principal amount as well in the third year, right? That's why. And then we discount it at what? Discount it at these rates. So different rates for every year. Okay, because your spot old rating is basically different for every year, right? So that's why we discount it all using all these rates, right? So it's always good to have this kind of table created so that you can just copy it across, right? And we get a valuation of 103 under old. Under the new rating, where is that? Under the new rating we get, under the new rating again we are just doing the same thing, but we discounted using the new rating, new rates, right? So we do this using this spot new rating, right? This is for triple B rating, right? We have used a higher discount factor, right? So we do that. For first year you use this rate, right? For the second year you use this rate, third year you use this rate, and then we get a present value of how much? 102.73, right? So our bond valuation has decreased. Why did it decrease? Because we used a higher discount rate, right? That's why. Right, now we need to also calculate yield to maturity, isn't it? Yield to maturity in the old rating thing as well. So in order to calculate that as well, we will need to discount it using different rates. We need to find at which point we will be like the yield IRR approach we can use, at which point we will have a zero value, okay, at what discount rate. Okay, so yield to maturity was basically, how do you calculate it? In the year 0 you have a payment of how much? 103.8 is our, isn't it, our bond valuation? Where is that? Our bond valuation is over here, okay? The valuation right now is 103.8. So in the year 1 to year 3 we are paying out 8, and then in the last year we are paying out 102, right? So using annuity we get at 8% discount rate, we get all this valuation which is negative value, right? So it's not zero exactly, so we need a discount factor which should be zero. So since it is already negative, what do? We have, using a higher discount rate, we are already getting negative, so we have to reduce the discount factor, okay? Because you don't want, if you discount it with 9 you will be getting higher negative value, right? And then you need something less that you should divide it with. That's why we use a discount factor of 7%, where we get a minute difference, right? So less, like equal to 0, something like that. And then what do? We can use the IRR approach. So IRR approach, the formula is basically the lower rate plus the lower number, let's say that, and then lower number minus the higher number, right, into this thing, higher rate minus lower rate. Okay, so you might be thinking 7 over here, you have the lower percentage, right? And then the lower number is basically not the lower number, let's say the positive number, right? So there is a formula that they normally make it, but you could do it this way as well, right? So you could just say you could assume the number to be like, let's say this thing to be yeah, lower, let's not say lower number, let's not say lower number, let's say A and then B. So it'll be A and then A minus B. We just need the distance between them, okay? That's why A minus B, and then after that what you can do is 0.42 divide by 2.19 minus 0.42, okay? So you could do that and then you can multiply it, okay? We just need the difference between them, right? The distance between them, right? So if you might be confused over here, but you will be getting the same result, that's for sure. You see what happens is the minus becomes positive, okay? So 0.42 minus, you are doing what, 0.42 minus 2.19, right? So it will be positive 0.42 plus 2.19. Okay, so you'll be getting 2.61, and then your upper value is 0.42, right? 0.42 divide by 2.61 times 1, right? It's going to be same thing, plus 7, so you're getting 7.16. okay, so there is a formula for it, you could use that as well, right? But yeah, and depends upon the situation, like how you want to create the formula, what kind of variables you want to use as well, right? So similarly under the new credit rating as well, we do the same thing, exactly same thing, but we use a different valuation at the beginning, because this is a valuation at the start, right? Under the new valuation after the credit rating has been revised. Okay, so at a discount rate of 8%, we are getting negative value, right? So that means we have to reduce the value to 7%, right? Using the IRR approach again, what do we get? Right, we get, just calculate the distance between them, right? We get a value of 7.58, right? So the market value has basically what, fallen by how much? Fallen by 1.10, right? 103.8 minus 102.7, 1.1 is the decrease, and then the yield to maturity has increased from what, 7.16 to 7.58. so that's a difference of what, 0.42%, right? So that has reason, right? It has reason. What else? Discuss the factors which may have affected the credit rating of Toltuck company published by the credit agency, right? The factors is basically, so you could divide it into different things as well: country, industry, management, right? Financial. So you could divide it, and then we can talk about like how there is recession within the country and all as well, right? So Toltuck companies, let's go into B number then. Yeah, so credit agency will be taking the following criteria into consideration when assessing Toltuck company's credit rating. Toltuck company debt would not normally be rated higher than the credit ratings of the country of origin, right? If the country's rating has been downgraded, your company's rating won't be higher than the country's rating. Okay, therefore the credit rating of Arumba land should normally be at least AA. The rating will also have depended on Toltuck company's standing relative to other companies in Arumba land. The credit ratings may have reckoned the Toltuck company's recent poor results. Remember, they had 2 failed developments, right? Which could have weakened its position. Right, that's another thing. Right, and it depends on its relative standing to other companies as well. The credit agency will have taken account of the impact of recession on property industries, right? Property construction companies generally in Arumba land. Toltuck company's position within the industry compared with competitors will also have been assessed if similar recent developments by competitors have been more successful. This is likely to have had an adverse impact on Toltuck company's rating. Right, the credit they have taken into account of the impact of recession and Toltuck company's position within the industry compared to its competitors. Remember, they told us about somewhere here, competitors, gearing has increased. Gearing in compared with other companies, right? Gearing has increased. right? Recent If similar recent developments by competitors, so let's say your development is unsuccessful but the competitors development could have been successful, right? So in that way its industry position is decreased, right? So this will have an adverse impact on Toltuck company's rating, right? And then management, right? Toltuck company's credit agency will also have made an overall assessment of management and succession planning at Toltuck company. It will have looked at business and financing strategies, planning and controls. It will also have assessed how successful management has been in terms of delivering financial results. The credit rating may have believed the poor returns on recent developments, so shortcomings in management decision making process, and it may have rated the current management team poorly. That could have been the reason. The credit agency will have analyzed financial results using measures such as return on capital employed, ROCE, right? The agency will also have assessed possible sources of future earnings growth, and it may have been skeptical about prospects, certainly for the short term, given Toltuck company's recent problems, right? The credit agency will also have assessed the financial position of Toltuck company, looking at its gearing, working capital management, and considering whether Toltuck company has enough cash to finance its needs, right? The agency will also have looked at Toltuck company's relationship with bankers, its debt covenants, to assess how flexible its source of finance are if it comes under stress, right? They will have looked at all those things as well, right? And it may well have been worried about Toltuck companies gearing being higher than industry. Remember how they are using the same word. It's always good to do that, right? You are referring to the case, right? So concerned about high level of cash it needs to finance operations. It will also have assessed returns on development in progress compared with commitments to repay loans. Greater doubt about Toltec company's ability to meet its commitments is likely to have a significant factor in fall in its ratings. Right, ability to meet its ability will have a significant factor in fall in its rating, right? The agency will also have needed reassurance about the quality of financial information it was using, right? So it will have looked at audit report and accounting policies as well. So next thing we need to talk about is, what was the other thing that we need to talk about? Discuss the impact in falling credit rating on its ability to raise financial capital and also on its shareholders return, right? Remember there was some kind of like some shareholders wanting higher and like they don't want a stable, and then minority wanted a stable return, right? And they regard it to be speculative. And the fall in credit rating, right? So we need to first of all talk about its ability to raise debt, right? Ability to raise debt, 7 marks, right? So Toltec company may not have increased problems raising debt finance if debt holders do not react in the same way as credit rating agency, right? May not, right? May not. How they react, it depends on that. They may attach different weightings to the criteria which they use. They may also come to different judgments about quality of management and financial stability. Debt holders may believe that the recent problems of Toltuck company has had generating returns may be due to external factors which its managements could not have controlled. They may believe, right? The debtors could believe. Generating returns was due to external factors, right? However, it is probable that the fall in Toltuck company's credit rating will result in it having more difficulty raising debt. Credit rating, right? Fall in credit rating will make it difficult to raise debt finance. Banks may be less willing to provide loans and investors less willing to subscribe for bonds, right? Less willing. Even if debt is available, it may come with covenants restricting further debt or gearing levels. This will mean that told a company requires substantial additional finance, it is more likely to have to make a right issue or new equity issue. Shareholders may be faced with a choice of subscribing large amounts of for new capital or having their influence diluted, right? So this may particularly worry the cautious shareholders, because if they don't have higher amount, like they will be less willing. As a result, what happens? Basically, now they are connecting the dots, now they are connecting the dots. If they need any, like they could have, there could be a, see how it's like a story, right? So credit rating, it means it will make it difficult to raise funds, right? So difficult to raise debt finance, right? And banks and investors are less willing to subscribe. As a result, what happens? The even if they do, suppose if they do, they will come with covenants, and as because of that covenants, you can't increase your gearing or further, or you can't even raise more debt, right? So if it requires any further debt or something, what should it do? If it requires more money, it has to go to, now the only last resort is basically issuing a right share, right? And then the right share is going to impact the cautious shareholders. Remember how they are connecting it. You see, it's like a woven story, huh? So even if Toltuck company can obtain the debt it needs, the predicted increase in yield, right? Predicted increase in yield to maturity may be matched by debt holders demanding higher coupon, right? Increase in yield maturity may be matched by demanding higher rate on debt. This will increase what? Finance cost, decrease profit, EPS, which will impact on share price, right? EPS will decrease, right? So that will possibly impact share price, and this will also mean that fewer funds may be available for paying dividends. So total company has been facing with difficult situation on balancing investment expenditure versus paying dividends, and these difficulties may well increase, right? May increase, has been faced with difficulties balancing investment expenditure versus paying out dividends, right? So if you don't spend on the money, you won't be generating returns on it, right? And then if you don't make investments, you can't pay dividend, can't be consistent in long term. Additional debt may also have other restrictive covenants. They may restrict Toltuck company from buying and selling of assets or its investment strategy. Restrictions on Toltuck company's decision about developments it undertakes may have adverse impact on shareholders' return, right? The restriction on it, right? So sometimes the project might be risky, but Toltuck management believes that it can like get it done, right? But they are not allowed to do it because of the restrictive covenants. Loan finance and bonds will come with repayment covenants. These may be required. This may require Toltuck company to build up a fund over time, which will be enough to redeem the debt at the end of its life, right? So fund over time. Given uncertainties over cash flows, this commitment to retain cash may make it more difficult to undertake major developments and to pay acceptable level of dividends, right? So because the cash is not available, because you'll have to have the funds basically stored so that you can make the redemption at the very end of the period, right? So you will need basically you'll need to separate a chunk for it at the separate the chunk of the money just to pay out at the end of its life, right? End of the debt's life. So the fall in Toltuck company's credit rating may result in its cost of equity rising. Credit rating, basically cost of equity will rise because people will and then what will happen? Basically people will think it is risky, and it will rise as well as its cost of debt, right? Cost of debt also rises, cost of equity is risen because of the credit rating fall, and based on that what will happen? Your WACC will also rise, okay? Your WACC will also rise. This will affect its investment choices because you will have to have a project which has a higher cash flow, because you see you're discounting at a higher rate, right? So you will need a project which is it could be you will need a project which will provide you higher return over the higher WACC. Hence its ability to generate wealth for its shareholders, right? This may result in told the company prioritizing developments offering better short-term returns, right? Not for long term, but they might want to have the short-term returns. They'll be prioritizing that. This may suit the more cautious shareholders, but the current majority may worry told the company will have to turn down opportunities which offer possibility of higher returns, right? Because because of the WACC, right? WACC changes a lot of things, right? It basically changes your investment choices, which is basically your ability to generate wealth for the shareholders, right? And then basically that will in turn make us choose projects which are good in short term but not in long term. So it's a very interwoven story, yeah? Very nicely interwoven. Of course we can't write all this thing in an exam setting, but yeah, this is like, you know, when you sip a coffee and then you're writing all this thing, you can think a lot of things, but in exam condition it's very hard to do so, right? So yeah, that's it for this video. If you don't understand anything from this video, do let me know, comment down below, and I'll definitely help you out. Thanks. Do share, like and subscribe. Take care. Bye bye.